You got it, guy. Hey, everybody. Good afternoon. This is Anthony D'Ambrosio from Supply Chain Solutions, and you are listening to the Ship Show Series podcast. Today's Thursday, October 12th, 2023, and this is episode 38 in our yearly series. Well, it's that time again, folks. It's all about the FMR, the Freight Market Roundup. So let's dive right in. But before we do, please allow us to pause for just a moment of silence to remember the great people of Israel and Palestine. We stand with them as they persist in their struggle, and we wish them nothing but the best. Let's just pause for a moment. Thank you, everyone. Finally, it's my pleasure to introduce my Ship Show co-host and partner, the amazing Jason Brand, our Director of Client Outreach and Development. Jason, how are you and what's happening today?
Oh man, I'm doing well. You and me joke about this there, but it's just like it's crazy. Um, we used to give our forecast for 2024, right? And now I
Yeah,
can't wait for 2025.
I know.
I hate to say it, but it's just we need a little bit of a rebalancing year to deal with all these ripple effects and kind of restabilize. But you know, let's dive into it. We got a lot to cover, and we want to get everybody a ton of information, get them in, get them out, and on with their days and weeks, and talking about all the stuff they learned on our show. So, let's get going. So, Freight Market Roundup, we got a few areas we cover, and we've got an agenda we like to keep. So, if you're new here, thank you so much for joining us. If you have been watching us in the past, you kind of know the gist and how we work, but I'll quick run through it for the newbies. So what we're going to do is we're going to run through our major ocean shipping lanes. We're going to start with the Trans-Pacific, then we're going to work our way to the Transatlantic, and finally we're going to end on a Southeast Asia going to Europe through the Suez Canal lane. Between those sections, we'll talk about some of the things that are hitting the news that are critical to shipping, our clients, or the industry at large. And then after that whole talk about the ocean section, we're going to move on to air freight, and then finally we're going to talk about oil and gas. So let's get going.
Absolutely.
Yeah. And a quick reminder too, we're talking about just the ocean portion here. We're not talking about the inland portion. So when we discuss rates, keep that in mind. So on our last freight market roundup, our ocean rates were hovering for the Trans-Pacific. So coming out of Southeast Asia and China, going into US West Coast, they were hovering at around 870 per 40-foot equivalent unit. And this week, they're hovering at around 1730. Now, this has kind of been on the decline. We saw a lot of capacity levers getting pulled earlier this year and also price levers. There was GRIs getting implemented. We had the peak season surcharges. On top of that, we are hitting literally the highs of this year of blank sailings. And all of that kind of culminated in around a $2,000 rate roughly a month ago. But you're seeing, even though we're deep in peak season, we're still declining. And that really is indicative of what's going on in the market as a whole right now. Before I dive into some news, Anthony, any kind of thoughts, opinions, feelings on that?
Yeah, no, Jay, thank you so much. I'm glad you asked me, because I think as the fourth quarter begins, I really think a cloud has settled over the container shipping market. And I know it sounds like a crazy analogy. I mean, the rate bumps that we saw in August of this year on the back of an extensive carrier blank sailing program that they put in place, and prior to that in May, is now in retreat of the traditional post-peak season lull, and a surge of new capacity, and a lot of doubts as to when or if the volume recovery will materialize in 2024 is really on everyone's mind. And I think, the spot rates in the eastbound Trans-Pacific and the West Coast since late August are down nearly 20%. And to the East Coast, those rates are down more than 30%. And the Asia to Europe spot rates are also down by half since early August. So for ocean, I think for ocean carriers, the efforts over the past year to stabilize the market through extensive blank sailings have disrupted customer supply chains. But it also largely failed to prevent further rate erosion. And I think the carriers in the eastbound Trans-Pacific say capacity reductions are likely to continue in 2024. And given that U.S. imports from Asia are expected to remain essentially muted or flat through the Lunar New Year this year in February and possibly beyond, I think it's a real mixed bag. And we're just really not sure how this is going to play out. But I think the big things are is carriers determine their 2024 network deployments. There's a lot of big questions that remain. And some of those questions are things like how much capacity should be deployed given the doubts of recovery will materialize next year? And to what degree should they opt to minimize the blank sailings, thereby offering a more consistent product, but likely needing to be more aggressive on pricing to fill the capacity they are leaving in the market? So those are a couple of the big questions that everybody's thinking about and that the carriers are thinking about as we get ready to leave 2023 over the next couple of months and move into 2024. So I know that was a long answer, Jay, but I kind of wanted to get that out.
I am so glad you did. And honestly, this is the right time for us to be talking about this, right? Because it's budgeting season. People are starting to kind of think about next year, what's going on, what do they need to plan for? And something we haven't talked about in a while, but it's really becoming a real solid concern for a lot of people are these new IMO initiatives and the fees associated with them. So we're still evaluating the best tools to be using to kind of find an accurate representation of what each vessel's rating is going to be and what each carrier is going to have as far as a new fee associated with shipping with the new carbon initiatives. And more on that, we're going to discuss that with you all as soon as we kind of lock in our plan. But there's a lot of things going on. And Anthony, you touched on quite a few. So it's kind of a tough moment, right? Because these low rates, if you are a shipper, obviously you're thankful. And if you are shipping right now that you're able to capture these low rates, but there's still a dilemma at the moment. And that's that like ocean schedule reliability. So if you look at when it was at its very worst during the pandemic, only 1 in 3 vessels was arriving on time. I mean, it was terrible. But if we look at the latest numbers for ocean schedule reliability on that Trans-Pacific lane, so coming from Southeast Asia, China, over to the US West Coast, we're still below 50%. I mean, it's unbelievable. And, so with that, you've got this dilemma as a shipper, getting these extremely low rates, but also not getting really a service level that is appropriate. So there's that situation. But, we also have exactly what you're talking about, hey, are we going to see more shipping before the Lunar New Year? And the concern is we are not. So, the industry as a whole, Anthony and I have been talking about this. We're kind of waiting for this demand rebound. And, the expectations for imports to come back, into the US from Asia, we keep pushing them back. We keep reading that they're getting pushed back. And, obviously with the overcapacity, the new capacity coming online in the next few years, that's just another situation that's going to make it more challenging for rate stability and also carriers to act in a stable way. But what we did see actually over the past week was there was a global strategy group. It's part of EY, Parthenon, and Bain. It's their consulting arm of, it's actually the consulting arm of Ernst & Young. So they made a couple predictions. They're expecting U.S. retail sales growth this year is only going to be 3%. Now, that's the 2024 year, or excuse me, that's going up into the beginning of 2024. If you compare that to last year, we had a 5.8%. And, if you go all the way back to 2021, obviously we had a huge burst as we had all this money kind of flood into the economy and also more available funds with people not, going into the office, not having to pay for gas, car maintenance, things like that. Back in 2021, it was a 13.2% growth. So as you can see, 13.2% 2021. As of last year, it was 5.8%. And then this year, we're only looking at a 3% growth. Now, to go a little bit more into the weeds and to kind of double down on some of those concerns of demand coming back, Bank of America and Citigroup both reported a slowdown in U.S. credit card spending in September. And generally speaking, you see the opposite happening around now. You start to see the spending increase as we get towards November. the Black Friday, things like that, it increases even more. And obviously, you've got your peak between Black Friday, or actually Black Friday, but in that final stretch of the year. But it's actually going down. And at the same time, we also have had the highest average credit card interest rate average this year that we've had in a very, very long time. To put this in perspective, right now we're looking at an average interest rate for credit cards at 23%. And if you go back before the pandemic, because you really need to kind of delete those years just because of this, what happened in the market. Back in 2019, the average credit card interest rate across the US was 14%. So we're sitting at 23%, a very high point. And the concern here, when you see this steady increase in that average credit card interest rate, it's really an example that, okay, maybe the Federal Reserve is holding off on rate hikes, but the effects of the old rate hikes haven't hit the market fully yet. And then at the same time, the effects of inflation also haven't hit the market fully yet. So all of this is essentially saying, okay, we're in peak season, spending is down, interest is higher. And so as a result, we're going to really need next year to sort out those ripples we were talking about earlier. Anthony, I know you love talking about this. I've got a few more things, but I want you to dive in right now before I kind of say the last couple points.
No, no, no. Why don't you go on, Jay, and then we'll come in on the back end about that because this whole economic situation, not only in the USA but globally, is a real mixed bag right now. You get a few good economic indicators, and then you get a mixed bag of things that aren't looking so good. So I think right now everyone is really confused as to where this is going to go. And like Jason was saying earlier, you have to keep in mind that last year or this year, from January through July, the industry, the container ship line industry, saw more than 1.2 million TEUs enter the global shipping fleet. So with all those new vessels that Jason was talking about, over 1.2 million 20-foot equipment units came into the rotation, and they only removed about 80,000 TEU capacity through vessel scrapping. So, where do we see what's going to happen next year when there's going to be 22% more new capacity coming into the industry? It's really going to be a mixed bag, and it's really interesting what Jason said about the metrics on the credit card spending too. I mean, we're in a real mixed bag, folks, and we're just going to have to keep an eye on this.
Not to throw salt on that wound that you just displayed there, Anthony. But so for example, we've got this influx of capacity. Journal of Commerce did a breakdown on their prediction on what they're expecting next year for what as far as import growth year over year, and what they're expecting is a single-digit growth. They're expecting a 5% at an aggressive level. If you consider 5% growth specifically on the Trans-Pacific lane compared to a increase of capacity that is going to far outweigh that, it's a little bit of an unstable situation. And another thing to consider is that even though we're going to have, or predicted to have, 5% growth next year, this is coming on the heels of a nearly 13% contraction we had this year. So we're still making up to where we need to be.
And just keep in mind, real quick, Jay, just keep in mind, you mentioned this earlier. So, folks, I mean, we have the Ukraine war going on. Now we have the conflict, in Israel. Okay. So now we have wars going on in two fronts. Okay. And there is, we're hearing a lot of things about that. And this could really affect the global shipping market and really drive rates up. Because if Middle East oil production is cut, we see that there's production cut, coming out of Russia, coming out of Ukraine. We're going to start to see the fuel surcharges go up, the bunkers go up. We're going to start to see capacity diminish. We're already, seeing a lot of things that's happening out there in the Middle East right now, in terms of blockades and things like that, that's going to affect the global shipping lane. So all of these type of things aside, coupled with the economics, are really going to affect the industry.
Yeah. And Anthony, that's a really good point. It took a couple months to really evaluate the damage from the Ukraine war. And, if you think about how many suppliers were located in Ukraine just for the automotive industry, it was insane. There were some really crazy figures that came out after that started. And, we still need to do a full analysis on everyone that's going to be affected due to this
Yeah.
conflict. But also its location is particularly challenging given, our Suez lane. And it's going to be really interesting. We've got it, and when I say interesting, it's obviously not a good situation, but interesting from a standpoint of understanding how this is going to affect shippers.
Absolutely.
And let's dive into Trans-Pacific. So our Trans-Pacific lane is coming from Europe into the U.S. East Coast. So the previous show, we actually watched our global shipping lanes see a boost come in from the use of these GRIs and PSSs and blank sailings. But what we didn't see is a boost in this lane. This lane has been actually a week over week loss leader for the longest time now. It's a funny lane when you look at it from the beginning of the year. It held on to those pandemic highs the longest. And now we're seeing it completely unaffected by these capacity levers as it just kind of has been tanking week over week. Now, this price decrease has slowed down, but it still is inching lower. So 3 weeks ago, we saw our averages for shipping on this lane, remember the ocean portion, at $13.80 per 40-foot equivalent unit. And now what we're seeing as of the last week's compiled averages, we're sitting at around $13.20 per 40-foot equivalent unit. So still inching down. A little thing to mention, though, what we have seen, I mean, if you are shipping a high amount of volume on this lane, we are able to even get you even lower than that. I mean, we've got a shipper that lock in under 1,100, which is nuts. And we actually have to exclude that from the data because it doesn't really show a clear picture. But if you are shipping a large volume right now between Europe and the US and you're paying at that $1,300 amount, you really need to kind of consider your strategy a little bit more because there definitely is opportunities. Anthony, before I dive into some stuff, anything you want to mention?
Yeah, just one thing on that. You made me think of this. So, let's keep in mind, everyone, that, October capacity is down, coming out of Asia Pacific, coming out of China, that Trans-Pacific because of the Golden Week. However, it's less of a drop than we saw during the Lunar New Year last year. Now, November's outlook is good, but, of course, it's subject to change with all these, what I'll call geopolitical shocks. It's just like, we do these planning, within SCS. We do, business sales expansion planning, emerging trends for the coming year. And we always talk about financial shocks and global shocks that could affect the market. But, we're going to have to watch this because demand out of China is just starting to come back online this week from Golden Week. And bookings over the next 1 to 2 weeks will determine the capacity for November with the carriers. So I think in Q4, in this fourth quarter outlook, we expect to see some good numbers, see a good number of blank sailings. But, with overall capacity comparable to Q2 and Q3 numbers, I think the pre-Lunar New Year push will likely start in early December. And, it will continue to build, especially with a lot more new ships coming into the rotation, these new builds, and they're going to continue coming online, which carriers will most likely offset with more blank sailings. And by moving smaller vessels into other markets, like, for example, from China to LATAM and places like that. So just my perspective, we're sort of okay, but, I think, we got to watch everything, but then we got to watch for that Chinese Lunar New Year push that'll start in early December.
Yeah. Honestly, really, we're hoping for that to be a little bit of a boost. That would help a bit in the markets. So one of the things we've been watching actually for a few years now, and it actually slowed down given this year and kind of the economic environment, is a lot of carriers making investment on land-based kind of logistics points. So another one has actually been happening right now, and it's got a little bit of different reasoning associated with it. So CGM, they're making a huge investment in electric vans for the European last mile delivery market. and they're partnering with Volvo and Renault to do so. So, in a statement from CMA CGM, from their CEO, he mentioned that they're not only investing in the project, but they're also viewing themselves as bringing the know-how and to essentially do this project in a cost-efficient manner and considering logistics. Volvo and Renault are actually going to take most of the heavy lifting. They're putting massive investments into this project as well. But the CEO also mentioned that the goal of investing in this project is to also decarbonize their fleet. Now, what's interesting about CMA, geez, CGA, just those three letters. What's interesting about them is they've actually got a decent land presence already. So they already own around 700 warehouses. They're operating in 50 terminals. And this is viewed as an expansion of that. It's actually not their first vehicle project they've done before, but this is their first wide scale, large vehicle project. And also when it comes to electrification, this is obviously given the new IMO regulations, which we're kind of teasing at today, this plays right into that. Now, another thing going on, Anthony and I haven't talked about this too much, but it involves the ILA. So, I mean, we've got to talk about this because the reason why we're not bringing it up is, generally speaking, these labor negotiations, they kind of stay under wraps. They're on media blackouts. When we had the situation at Yellow, that was so media heavy that it did actually, I think, draw out some ILA stories that normally wouldn't have hit the news. But because that's gone, it's been very silent, even though there's been a lot of issues going on at the moment. So really what's going on, they're still figuring out their contracts. And on last Friday, a Federal Maritime Commission administrative law judge dismissed these claims from the group, the ILA, that stevedores at the ports of Savannah and Charleston engaged in price fixing. And they also ruled that stevedores are not marine terminal operators, and they have the full power to set fees and rates for container handling. Now, all of this kind of came out of this complaint that was originally brought on the ILA back in April of 2022. And it was alleging that the terminals, Ceres Marine and also Port America and SSA Marine, were coordinating in their rates and essentially price fixing. So as a result, of this dismissal, this is kind of a blow to ILA. There's been a lot of discussion around this lawsuit getting brought on as a way for the ILA to kind of infiltrate some of the state worker positions. The timing is interesting. It happened before the ILWU started their negotiations. So it kind of looks like a little bit of kind of getting ready to dig their teeth into something. But what's been happening is essentially the ILA really wants there to be union labor on some of the cranes in these ports that are using state workers. And this has been the point of contention that the ILA has been really deeply involved in. And they really haven't been making as much ground, I think, as they expected to. Anthony, as our boots on the ground on the U.S. East Coast, you gotta give me your flavor on this.
Well, yeah, for sure. But I do want to also tell you, and I know you're very astute with this stuff, and I don't know if you saw this yet, but just last night I've received like a notification that the ILWU dock workers unions sway at the West Coast ports is tested in bankruptcy. So essentially, in advance of a judgment against it for what a federal jury found to be illegal work stoppages at the Port of Portland in 2019, the ILWU has declared bankruptcy. So the ILWU represents, as everyone knows, and as often as Jason and I mentioned this to all of our listeners, they represent more than 22,000 workers at 29 ports along the West Coast. And as such, they wield really a significant amount of leverage when it comes to port operations and controlling the flow of goods entering and leaving the U.S. So we're really going to have to keep a close watch on what this bankruptcy really means. It was just a little news flash that I received, and I'm actually doing a little bit more investigation and discovery on this, and we'll have more on this for you in the coming weeks. But, as Jason asked, as it relates to the ILA on the East Coast, I mean, thank God right now, it's business as usual. But what happens is these unions are all interconnected. I think unions are a great thing for our union workers in the country, but we are expected to see a little volatility on the East Coast, especially in the biggest ports of New York and Baltimore and Norfolk and Charleston and Savannah as we move into 2024. We're hearing some rumblings right now that there could be some work stoppages, but right now it's just speculation and rumor. Sometimes they put this kind of news out there because they are trying to get leverage and renegotiating increases. So we're just going to have to keep our finger on the pulse of that.
Love it, Anthony. I'm glad you brought that up about the ILWU. Quite frankly, I was a little bit concerned about mentioning it because I didn't understand the full thing. You did a great job bringing it up, though, because yeah, it's a little after the fact, right? We had the ILWU actually finally come to an agreement, and we saw it got really ugly there in the end. And we really didn't know where it was going to go. But yeah, this is very shocking. I'm really curious to see how that unfolds. We do need to go over that in the next couple of weeks. Let's dive in. Let's talk about our last major lane. This is our Southeast Asia, China, going through the Suez and going into Europe. So what we've seen in this lane, I used to call this the barometer of global shipping because it really was slow and steady. It wasn't as much of a knee-jerk reaction lane. When it was high, you'd expect the other lanes to be high. When it was low, you'd expect the other lanes to be low or be going lower. And, we had a little bit of a situation in this lane at the beginning of this year where we saw acting wildly. But if we literally delete that data and we look at everything else, it tends to be steady. And what we've seen with this lane is a very steady and very, very clear decrease in price over the past 2+ months. And when I say very steady, I mean, it's like almost incremental. It almost looks like a GRI except reversed. So what we've got is just 3 weeks back, we were looking at $1,200. If we go 3 weeks before that, it was $1,400. And if you go to our averages right now, it's at $950. So it's been pretty smoothly a $200 decrease every few weeks. And at $950, we're looking at the cheapest ocean lane right now out of all of our major shipping lanes. And while that is concerning because that price is incredibly low, I mean, it's definitely indicative of just a demand issue. Also, you have to remember this lane has a lot of stops. So there's a different story sometimes going on with this lane than what you see in the price trends. That being said, China has been dealing with some issues lately, and we brought this up on a show. I actually believe it was our last Freight Market Roundup, but this involves the real estate developer, the Evergrande. So they had an 11th hour cancellation of this bond restructuring deal that covered more than $19 billion worth of their international assets in bonds. And it's got the government worried of a potential catastrophic collapse. And it also is got all the other companies in the sector that aren't doing particularly well at this moment concerned about that too. And so, Evergrande is a huge multinational Chinese real estate developer. And, they just had their executive team arrested over the past 3 months. And then most notably, the CEO was just arrested as well. And, on the heels of this bond restructuring cancellation that really happened at the 11th hour, China stepped up and the government essentially vowed to increase the intensity of their risk monitoring and bad asset disposal for the smaller banks. And also they are, they're going to be doing a lot. Anthony, I know you want to talk about this too. So before I dive into some of this, give me your spin on this.
It's a real fly in the ointment. I hate to generalize it like that because it's really going to cause a ripple effect. Again, I've said it a number of times on today's show about things being a misbag. I mean, especially with things going on over there in China right now. But I think one of the things I do want to say to our listeners, kind of segues into this, but a little bit more about some of the congestion that's starting to build up over in the transshipment ports of Busan and Singapore, where a lot of these vessels that are loading in Ningbo and Yantian and Shenzhen and Dalian over in China, because of some of these internal issues going on in China, because of new capacity and vessels, coming on board, vessel scrapping, different vessels going into different rotations. Um, you know, congestion at the transshipment ports in Asia remains a big issue. So I think our listeners should prepare to see containers rolled over the coming weeks and months, the rest of this year. And I think shipments really could be delayed as much as 10 to 14 days at some of the major ports. So a lot of these vessels go via Busan, Korea, via Singapore. And, a lot of these delays at the transshipment ports are leading carriers to push for business on direct services only. And I think the congestion is really expected to ease, as we come to the end of the Lunar New Year, logically. But there's a lot of things going on right now. And, you know, uh, what Jason was talking about with the Evergrande and some of the issues in there, some of those big real estate companies and those big businesses in China, they own several barge companies in South China. And as a result of some of these issues, a lot of those barge companies are going to be suspending their operations on the Pearl River Delta because of some financial issues right now. And that's really going to affect direct ports of call like Hong Kong and Yantian because of some of these financial issues and how some of these big national companies like Evergrande over in China, they own some of these other peripheral companies like many of the barge companies. So I know I went down a rabbit hole on that, Jason, but apologies.
No, it's a good rabbit hole. Yeah. And I think you touched on a lot of the concerns there. So, the problem really is the banking sector right now in China is getting a pretty big lockdown from the government. And so, for the businesses that are going obviously through the Chinese banking sector, they're subject to being, their bad assets or potentially are going to be targeted. So, a couple of things they're doing. Essentially, the Chinese government, it's going to work with commercial banks and rural institutions. And specifically, they stated this, they're going to be disposing of bad assets and bad loans. And they're going to be replenishing capital through multiple channels. This is quoted. This is a move that is completely based off of the fear of Evergrande collapsing and needing to prevent a financial contagion. So, what another announcement was made is over the next 5 years, they're going to strive to kind of restructure their financial system and essentially clean it up. But yeah, unfortunately, there's just a very high level of bad loans, and the fundraising costs for kind of covering all of these bad investments are stubbornly high. So just as Anthony said, that's such a great point. So many of these companies are diversified in places you would never expect them to be, but they are. And so the ripple effects of, the real estate situation is going to have wide-reaching effects. Let's dive into air. It's going to be pretty quick talking about it. So obviously, we just got out of Golden Week, and we had those very high air rates leading into Golden Week. Now, just as we expected, air rates were going to be dropping. So we were looking at around $6.45 a kilo before Golden Week. Right now, we're looking at $6.19 a kilo for this week. But what I will say is if you do need it, if you are planning on shipping air in the next few weeks, try to hold out as long as you can. Obviously, we do need time to essentially book your shipment, but we are expecting these rates to go back into the $5 range pretty quickly, definitely before the end of the month. Anthony, any thoughts, opinions on that?
Yeah, just a couple of little anecdotal notes. I just wanted to say, and I'm glad you brought that up because, IATA, which is the International Airline Transportation Association, just published a report 2 days ago that they saw the first air cargo demand growth in the last 19 months as part of its August air freight analysis. And they released numbers showing that the global cargo tonnage, or what they like to call the CTKs, the global cargo tonnage kilometers, were up 1.5% year on year at the same time. And they showed that the CDKs, that cargo tonnage kilometers, being 1.3% below the pre-pandemic levels in 2019. So I mean, basically, the bottom line is, according to IATA, air cargo demand grew by 1.5% over the previous August. And that is really interesting. I mean, this is the first year-on-year growth in 19 months. So it's certainly welcome news, but it is off of a low in 2022 of the 2022 base. So the market signals are a little mixed, but at the same time, I think, when we're talking about air freights, whether it's Asia, whether it's Europe, as we go into the fourth quarter, there was really a build up to a really relatively modest peak season. Okay. Especially on air freight. And a lot of this was driven mainly by the e-commerce products demand for the upcoming holiday season, which we're now entering, especially out of China. And with all the new technology launches that, Jay, that's one thing I always hear from you about, how Apple's launching their new iPhone 15. So, like Jason said, rates are picking up. This is impacted by continually elevated jet fuel prices. So, although the capacity is tightening from flight cancellations and increased demand for specific train lanes, it's definitely going to be impacted by seasonal demand. And as I said, we hate to bring up these things, these conflicts like Ukraine and Israel now, but if we start to see oil prices go up as a result of this even further, it's going to cause jet fuel to go up, and it's going to cause diesel fuel and low sulfur fuel to go up. And in Europe, and I know I'm a little long-winded here, Jay, I apologize. In Europe, I think we can expect a slight rate increase as carriers begin to implement their winter schedules, for this month in October. I mean, currently there's no disruptions expected out of Europe on the air freight side of things, out of every major airport. Things are running smoothly, and capacity is widely available. But we do have to be, very watchful and mindful of this, because there are some things going on in France right now with repeated labor strikes in response to President Macron's plan to raise the pension ages. So that could cause a whole bunch of dominoes to, ripple effects out in the EU, especially in France, that'll affect everything. So I know I kind of gear shifted to a few different areas there, Jay, but I wanted to just give you a few things about air freight.
No, honestly, no, that was great. It was great. It's interesting. I'm really feeling like this little boost in air freight though has got it's partially due to this, almost year high of blank sailings coming, during this time period, right? We're in this week after Golden Week. And then, it's funny too. Generally speaking, Apple is a big contributor to those air freight prices. And I need to get some solid facts on this. I actually haven't been able to nail down exactly how much they shifted, but they announced they were going to slow down on their air usage, and they were going to move a lot of electronics that they wouldn't allow in ocean containers this year. So it's like the fact that we're seeing this year-over-year growth, it's good, obviously. That's fantastic. We need to see it recover. And I totally agree. With fuel, diesel, gas, we had 1 week of a relief, because it's quite frankly been slowly creeping up week over week for the past couple months. And what we saw in diesel is a 10-cent drop in 1 week. We're seeing this at the beginning of the year. We've not seen this for a while. So used to be roughly $5.59 a gallon of diesel, and now it is $5.49, or excuse me, $4.59. Oh man, I got the whole numbers messed up. Let's start over. $4.59 a gallon as of 3 weeks ago, and now it's $4.49. Anthony, I think I just said too many numbers today, and what's happened is they're all merging together. Point is, we're down 10 cents a gallon in diesel, and we actually saw the same benefits in the gasoline market as well. This conflict in Israel, though, is likely to affect these. So view this as kind of a short benefit. But going forward, we're probably going to have a little bit of an increase in these prices. So
yeah, and Jay, just one thing. Hold your thought for just 1 second, please. So you bring up a good point about that oil and gas. Now, let's just have everyone keep this in mind, folks, that when we think of crude oil, the Straits of Hormuz, unlike the Suez Canal, is really a closed choke point, meaning you can't go around it, okay? And enormous volumes of oil and gas exports rely on the strait being open. So for example, I mean, if cargoes were forced to circumvent the Suez Canal, it would be positive for the shipping demand, okay? But if there becomes real issues where, that those oil tankers and those gas exports, those liquid gas carriers, okay, people think of crude, but people don't think about those liquid gas carrier vessels that carry liquid gas. If there is a real problem that continues to be a flashpoint out there in the Straits of Hormuz, that could really send oil and gas through the roof. And I just wanted to add that in there, Jay.
Yeah, it's also the season where this is actually a bigger concern, right? Because everyone's building up their reserves for winter, and so that's something to consider as well. Hey guys, really enjoyed you guys joining us for today. There is a lot going on, and we're going to be breaking this down over the next couple of weeks. But thank you so much, Anthony. You want to close us out?
Make it a great day, guys.
Hey, thanks everyone.
Thanks everyone. Bye bye now.